Welcome back. Well, it now takes 297 months to save for a down payment for the average home in Toronto. 340 months in Vancouver. That puts home ownership out of reach for many of Canada's larger urban centres. Meanwhile, average rents across the country are at record highs and climbing. Where does all of that leave young people when it comes to a decent place to live? Kyle Dahms is an economist with National Bank of Canada. Kyle, thanks for being with us.
Thank you for having me.
So these affordability numbers that National Bank compiled are alarming and, obviously kind of multi-year highs. If we put that in the context of a young person trying to get into this market, how daunting is it right now?
Well, certainly we have seen an improvement over the last couple quarters when it comes to housing affordability. So we've actually seen our index improve on the basis that home prices have declined over the last 3 quarters. Incomes are still rising and mortgage interest rates have come down a bit. But certainly if we look at it from a down payment perspective, things are quite dire. On the national average basis, it would take about 73 months, give or take, to save for that down payment, whereas it's been on average about, I would say, 41 months since the early 2000s. So things, are certainly have improved in the short term, but if we look on the longer perspective, it's not an ideal situation for those first-time home buyers.
And I mean, I guess the kind of context I'm wondering about this is how important is it to be a homeowner, and how important is it to start that process young? Because there's a whole kind of cohort that's being shut out of this. It's just too expensive. It takes too long. By the time they can afford it, they're just older. Does that have longer-term consequences for people's finances?
Certainly, because housing has often been seen as a bit of an investment vehicle, although a primary home shouldn't necessarily be an investment. It certainly has been for the majority of Canadians, as they've seen home prices increase over the last 20 years at quite high multiples. So if you're not in the housing market, there's certainly some aspect of having that leveraged investment that you're missing out on. And normally the rental market would have been one area where you would have been able to perhaps save a bit on a monthly payment basis and be able to put some money aside and reinvest those proceeds from, let's say, the stock market, right? But that hasn't proven to be true in the last little while, as rents have gone up quite considerably. Mm-hmm. And now we're seeing vacancy rates in major Canadian cities that are at nearly all-time lows. So that's certainly a tough situation for the rental market as well.
The other piece of this, of course, Kyle, is that people who can break into that market are presumably spending more of their income on the mortgage. In other words, their savings in other ways and their spending in other ways will also be affected. Does that create kind of a change in the economics of the country? In other words, should we have different expectations about what spending will look like when we have a generation that might be a little bit house poor?
Right, yeah. In terms of how people allocate their income, if they're having to increasingly put their income towards housing, whether it be towards mortgage payments or just for having to purchase a home, they're going to reduce consumption in other areas of their lives, right? And we've obviously seen inflation be a major theme over the last year and a half, and budgets have obviously had to shift just due to the increasing price of goods and services. So certainly it's squeezing a lot of people. Canadians have done fairly well due to, decent excess savings, but as those excess savings start to go away and people start to dole them out, mm-hmm. Certainly we could see a bit of a squeeze happening for Canadians.
Just a few seconds here, but do you see this changing anytime soon?
With the recent interest rate increase by the Bank of Canada, I think things could get a bit tougher in the upcoming period, especially as we've seen mortgage interest rates go up slightly. But certainly we see a first rate cut in the first quarter of 2024, so we could see some improvement on that side.
So good to have you, Kyle. Appreciate it.
Thank you for having me.
Kyle Dahms is an economist with National Bank. A growing number of younger Canadians are finding themselves insolvent and either declaring bankruptcy or working out some arrangement with creditors. Student loans and credit cards are typical culprits, but the high cost of living leaves some with few options. Doug Hoyes is co-founder of insolvency firm Hoyes McLose. Thanks for being with us.
Thanks, Amanda.
So the numbers actually are pretty staggeringly high in terms of the proportion of millennials filing for these insolvencies. What's going on? And does this jump out at you as an anomaly in your experience?
Well, it's certainly an anomaly looking at past history. If you look at the population of Canada over the age of 18, like, I don't know, a quarter of them are millennials. But in terms of filing insolvency, it's more like half of all people filing insolvency are millennials. So they certainly have a disproportionate share of the insolvency pie. But when you think about it, it kind of makes sense. Boomers, who also get into financial trouble, are much more likely to have owned a home for 20 years. So even if they have credit card debt, well, they've got a home they can rely on, they can refinance it, they can sell it. If you're a millennial, someone who's 30 years old, for example, you probably never got into the housing market. You don't have any assets backing you up. So when you get into financial trouble, well, you have no safety net.
I guess that does lead me, though, to wonder if those same young people are setting themselves up for difficulty getting into that housing market, for instance, getting additional credit down the road. What's the outcome of this process for the young people that are finding themselves needing to do it?
Well, you're absolutely right. And so you mentioned student loans. Well, that's much more likely to affect someone at the younger end of the demographic age than older. So you graduate from school at the age of 22, but you graduate with student loans. And if it's going to take you 10 years to pay off your student loans, then during that time period, you're certainly not buying a house because you've got all these other debts to service. And if anything goes wrong, if you don't get that fantastic job right out of school, then what do? Well, now you've got to rely on things like credit cards or high interest installment loans. So you're making your debt levels even higher. So it's much less likely that someone who's young can get into the housing market, much like somebody 30 years ago could have. So it's certainly delaying all of those things, buying a house, family formation, all of those things.
So then does that lead us to, if we kind of follow that logic through, Doug, a home is often the kind of forced savings for a lot of Canadians. It's where we store up value almost unwittingly over time. Are we now creating a kind of a whole cohort of people that won't have that option or won't come to it soon enough, and therefore will be elderly people with less means and more debt?
Yes, that's exactly where the trend is going. Now, I can't see into the future 20 or 30 years. Perhaps we have a correction. Maybe we have a recession. Maybe housing prices come down. Maybe immigration changes. We don't have as many new people coming in. And as a result, people can get into the housing market. But as it stands right now, it is almost impossible for somebody who's 30 years old to be buying a house unless they've got support from the bank of mom and dad. So yes, you've absolutely carved out a significant portion of the population who simply cannot get into the real estate market.
Now, we know because of education and because of changing of thinking around this, there are just more kind of consumer proposals, working things out with creditors than there have been in the past. That's a good, healthy thing, I would say. What does it say, though, that we've got young people finding themselves in over their heads at this extent? How much of that is about their own attitudes that they're bringing to it, and how much of it is just that the cost of living and the debts that they have by the time they get to that age are beyond their control?
Well, and you cannot generalize. There is no one human being who represents everything. Certainly, there are young people and old people who were not good with their money and spent too much money. But I think it's much more likely that the young person has gotten into trouble through no fault of their own, or there wasn't a whole lot they could have done otherwise. When I went to school, 35 years ago, tuition was $1,000 a year. I could get a summer job, pay for it myself. That's impossible now. You're going to university now, and unless your parents are able to pay for it, it's impossible to get a minimum wage summer job and pay for the cost of school. So you have to take on student debt, which is what we tell you to do. You got to improve yourself, get an education. So you're starting off with that limitation. And then unless you get the perfect job coming out of school, we all know what costs are like. Wages are not going up as fast as what costs have gone up: inflation, food costs, rental costs, all those sorts of things. So you're starting off with debt, and then you're getting into a market where your cash flow is constrained. It's not really a surprise that a significant number of people then rely on debt, get into trouble, and have to resort to a consumer proposal to extricate themselves from it.
Tough times. Doug, it's good to have your thoughts on this. Appreciate it.
Thanks, Amanda.
Doug Hoyes is co-founder of Hoyes Miklos. Coming up, our economy is changing and new technology could upend most jobs. So how does a young person prepare? Stay with us.